Aloha, George Krischke with Honolulu High Five. Today we're going to talk about HARPTA and FIRPTA. Now, there was a time when foreign investors bought Hawaii properties and they held them for some time and eventually sold them with substantial gains without ever paying any required capital gains taxes. They never filed any tax returns. They just took the money and ran. To protect the state and the federal government from the loss of capital gains tax revenue, HARPTA and FIRPTA laws were established. So anybody coming from anywhere in the world can buy Hawaii real estate. It doesn't matter where they live, where they come from, what country, what state, wherever from. There's no restrictions, but when it comes to selling, HARPTA and FIRPTA does apply, and it needs to be sellers that don't live in Hawaii need to be aware of what it means when they sell their property. So let's take a look. Let's start with HARPTA. HARPTA is an acronym for Hawaii Real Property Tax Act. This is a Hawaii state law that requires a withholding of 5% of the sales price. This is 5% of the sales price, not 5% of the gains realized. This is 5% of the sales price from the seller when the seller is an out-of-state resident. When the seller is not a resident of Hawaii, when the seller is an out-of-state resident. Now, there are some definitions on who is a Hawaii resident and who is a non-Hawaii resident, or an out-of-state resident, I should say. So we can take a look at that at another time. Sellers may recoup some of the withholdings beyond the applicable capital gains tax by filing the appropriate form. Now, let's talk about FIRPTA, which is an acronym for Foreign Investment in Real Property Tax Act. That's a federal law that requires a withholding of 10% of the sales price. Not 10% of the gains realized, but 10% of the sales price from the seller when the seller is an out-of-the-country resident. Now, you understand, if the seller is an out-of-the-country resident, he's not only out of the country, he's also out of the state. So for somebody out of the country, HARPTA and FIRPTA applies. So that's 5% HARPTA withholdings plus 10% FIRPTA withholdings of the sales price. Now, sellers may recoup some of the withholdings beyond the applicable capital gains tax by filing the appropriate form. So HARPTA and FIRPTA is basically a mechanism to withhold, and then you can file the forms which allows you to calculate what really the appropriate capital gains tax should be, and then you can get a refund of the balance that has been withheld beyond what is due in capital gains taxes. That's HARPTA and FIRPTA. Now, one more thing about this. Sellers need to know that the sale of an investment property may also raise questions by the Department of Taxation regarding rental income received. The state of Hawaii requires anybody that receives rental income to pay the appropriate GET, that's the general excise tax, and if it's short-term rental income, less than 180 days, then there would be also applicable TAT taxes. TAT is the transient accommodation tax. And if you sell your property and there's HARPTA and FIRPTA withholdings, the tax department may also look into the records if you have filed the appropriate, if you have paid the appropriate general excise tax and possibly transient accommodation tax. Check with your agent and discuss it with your agent. With all tax matters, always check with your favorite qualified tax professional. That's it for today. Thanks and aloha.